Open House, Episode 5. My name is Jonathan Stern. I'm here today with George Noble, portfolio manager with more than 40 years of investment industry experience. He was the initial portfolio manager of the Fidelity Overseas Fund and has since launched two $1 billion hedge funds. He is now president and CEO of the Noble Family Office. George Noble, welcome to Open House.
Thanks for having me, Jonathan. It's a pleasure to be here.
You've been the most outspoken Opendoor bear on the entire internet over the last 4 to 5 weeks. Tell us why.
So, as of a month ago, I had never heard of Opendoor. And I went on a Space morning finance show, and Eric Jackson appeared and started talking about the company. And I was listening to the explanation, but then when I heard the notion, the encouragement, the idea that the stock will go up 100x, my ears perked up. I've never heard anyone say anything like that before. And
what was the price? Do you remember the price at the time of the
Yeah, it was like between 6 and 7. I think it was on Friday, the 5th of September, if I got my dates right. I can't remember exactly.
Okay.
The stock spiked up that day. I think it was at 7 or something like that. It's now higher. It's like 8, so whatever. But I don't get caught up in the day-to-day gyrations of the stock price. So if I hear someone pitch an idea that's going to go up 100x, my advice is you run, don't walk as fast as possible away from such an idea. You know, the term 100 bagger, which comes from the term 10 bagger, which was coined by my former boss, Peter Lynch. You know, he would say that if you have a 10 bagger, one 10 bagger, a couple 10 baggers, whatever, consider yourself very fortunate. And the more important thing is, when you buy a stock, Peter would always say, you have no idea what your biggest winner is going to be. It's not like the idea you're most positive on winds up being your biggest winner. Stories evolve over time. And when you look back on your biggest winners, typically the way it rolls is, you buy a stock because you think it might go up, 50%, 100%, whatever. And as time goes by, the story progresses. And as Peter always used to say, can you upgrade the story or downgrade the story? Is the story getting better or is it getting worse? And so maybe you have a company with a product where, you think the stock price should double, but the addressable market for the product gets bigger, they come up with new products, whatever. And the story improves. But the idea that you're going to buy a stock because it's going to go up tenfold, you think it's going to go up tenfold when you buy it? That's just not a thing in responsible investment circles. And to say something's going to go up 100-fold, it's like, wait a second. We can get into a discussion of whether it's deliberate misleading or it's analytical malpractice, but one should be very suspicious of claims of 100-fold increases.
I'm with you that we should be suspicious, and yet since Eric Jackson made that initial tweet thread on July 14th, I think, the stock price is up 10x. Not 100x, and I don't think he was calling for 100x over 2 months, but it is up 10x. So I want to click into why and why you're still skeptical of the stock and where you think it's going to go from here. But I want to get this on the table first. Just to confirm, you don't have any position in Opendoor.
I have no position. Thank you for asking that.
And you are bearish at these levels, but no position, right?
Correct. And so let me answer that. Thank you for bringing that up. As I'm reminded, there's your portfolio and there are your beliefs. Yeah. And those two aren't always the same. In the case of Opendoor, clearly it's captured the imagination of individual investors. And congratulations to Eric for catching the stock at 50 cents or 80 cents or wherever he bought it. And if you want to speculate, that's fine. I have no problem with that. But let's not confuse momentum-based speculation with a fundamental investment. And that's where I really have a hard time. I have no position in the stock because clearly it's not fundamentals that are driving the price right now. The same can be said for a lot of other names actually as well. We're in a momentum-based market where themes, concepts are driving a lot of names. And I'm reminded of the saying, I think it came from Warren Buffett, in the short run, the stock market's a popularity contest, but in the long run, it's a weighing mechanism. Ultimately, fundamentals will out. And hey, if I'm totally wrong, Opendoor is going to go up a lot. But if I'm right, not only will it not go to 82, I think there's a good chance the stock goes back to $2. And that's where fundamental assessment comes in. And it's not just based on valuation. We need to break the business down to its constituent parts. And I'll explain why I'm negative on the stock. So I'm going to be very clear. And for, X, which is a crazy place, people say, oh, you have no position, smarty pants. You're not allowed to have a position. And, you're not allowed to have an opinion unless you have a position. You can't. John, it's hysterical.
I just want to say I do have a position, and I'm long Opendoor. We've chatted on the phone many times, and I've seen some nasty things said about you on Twitter or X, and I just have to say we're friends, George.
No,
we disagree. Yeah.
And you know what? In a way, it's a metaphor for what goes on more generally in society with people have difference of opinions about politics and other things. We can civilly agree to disagree, but just because you and I disagree on something, I'm not going to call you an idiot. You're not going to call me an a-hole or whatever, okay? But the funny thing was...
We'll see what happens here over the course of the interview. But for the moment, we're good, yes.
No, we're good. And we are going to be good no matter what. I mean, listen, if we agreed on everything, there'd be something wrong. And it's no fun.
Yeah.
So coming back to Opendoor, how to think about what the stock is worth, which... at the end of the day, if you're investing, that's really the important question to ask. I mean, I was trained that, over the long run, on average, stock prices follow earnings. Peter Lynch used to pull out a long-term chart of Coca-Cola and show how Coke went up 30x over a number of years. And on these long-term charts, these cyclograph charts, you also see the earnings per share line. And you'd say, look, guess what? That also went up 30x over a number of years. So the stock price follows earnings. Not every week, not every quarter. But over the longer term, the evolution of stock prices, it's not a random development. There's a fundamental story behind each share price. So let's go to Opendoor. You have a company which, since inception in 2014, has never made money. Loss after loss after loss.
On a yearly basis.
On a yearly basis. And that's the way quarters. And that's the way it should be looked at. I'd like to remind people. Let's take a simple example.
Yeah.
If you look at, say, a retail stock, a retailer, as you know, retailers make the large bulk. I'm not talking about things like Costco. I'm just talking about in general. Retail is a somewhat seasonal business. As we all know, the Christmas season tends to be the biggest quarter. So you can see for many retailers, they'll make very little money. They may even lose money in the off quarters, but they kill it in the Christmas season. So to say, well, they made money in this quarter, that doesn't wash. All right, I'm talking on an annual basis. Okay.
Right.
So Opendoor has never made money. The company has, we're going to get into margins in a minute. The company has a very low gross margin of only 8%. They, I think over the trailing 12 months, had about $5.1 billion in revenues, had about $400 million in gross profits. 8% gross margin, give or take. There have been years where it's been a lot lower. I think, in fact, for the upcoming quarters, where they're forecasting, I think it's a 40 or 50% decline in revenues for the next couple of quarters, expecting margins to even go down. So margins have gone between like 2% and 10%, whatever. Okay, they were at 8% for the last 12 months.
I do think it's worth noting as well that a few years ago, revenues were in the, I think, 15 billion range. And as you said, I think gross margins have been around there, the 5 to 10% range.
Correct.
But revenues were way elevated 2 or 3 years ago.
And we're going to
much higher losses due to the homes that were purchased.
We'll get into all that. But let's think about how would you value Opendoor? Because I really think when you get past everything else, that's really the key issue here. Forget about whether I'm a boomer or forget about whether Eric is standing on the front lawn of Drake's place. In the final analysis, none of that's going to matter. Okay, the fundamentals will out. So let's talk about the fundamentals. So I have a company which, and I get people say, well, the future's not going to be anything like the past. Okay, fine. However, let's play with that a little bit. So for now, they are still embracing the house flipping model, the iBuying model. Maybe that will change, but most of the stuff you read suggests it's not going to change. The problem I really have is I can't get from here to there in terms of building an earnings model or thinking about the unit economics are going to change in such a way that are going to justify a $9 stock price. Forget about $82. It's one thing if you have a company which is coming out with brand new products, and the bulls will say, well, mortgage and title, whatever. We'll get to that in a second, okay? Coming out with brand new products or big new markets, and, or you have a drug, let's say, where the prescribed uses for X number of cases, and now it's going to some other applications. Fine. But let's break Opendoor down to its constituent parts. So house flipping is a tough business. As we just discussed, it's they've generated, let's use an 8% margin, gross margin. You can use a higher number, lower margin, do whatever you want. And let's assume, Eric, to your point, okay, we can do min-max probable. We're just trying to get the leverage, get a feel for if it all went right, if it all went wrong, what could it be on a good day, what could it be on a bad day? So to start the conversation, all right, let's go back. You mentioned $15 billion with a peak prior sales.
I think Eric, 2022 maybe.
Yeah. Okay. And that was the boom of all booms in housing. Okay. And I think Eric has cited the consensus number for 2029 revenues of $12 billion. That's what he's okay.
Correct.
And so let's run with that. Okay. You have $12 billion in gross sales. And I want to get to gross margins versus total revenue dollars in a minute. But $12 billion in gross sales, and you say to yourself, okay, what would be a reasonable profit margin? Let's play with that a little bit. What could we come up with as a profit margin? What might be plausible?
On $12 billion.
On $12 billion.
Yeah.
Not on, by the way, given the sales decline they're looking for the next couple of quarters, I mentioned before, trailing 12 months revenues of $5.1 billion. They'll probably be down to I think they're going to be like 4.2 or something for the entire year. So we're giving a lot of credit. We're saying, okay, we're going to go from $4 billion to $12 billion. Forget about how we're going to get there. It's going to happen. And by the way, another point, people just assume, we're now into another massive rate cutting cycle, and somehow that's going to make long-term interest rates go down. It's a whole nother story. Okay, but just leave that aside for a second. Right?
I just want to say I'd be shocked if we're not well above 12 billion, but let's roll with 12. I actually don't think the market's pricing in 12. But let's use Eric's number to your point.
Yeah, let's use Eric's number, okay? Let's use 12. Okay?
Let's start with that, yes.
Start with that, okay. And then say, okay, look at what this company's earned in the past. And then let's just wave a magic wand. I want to leave mortgage and title out for a second, all right? Eric will even admit that Opendoor, he likes to use Carvana, which is a totally fallacious comparison, but be as it may.
We do need to get into that.
Of course, we're going to get into it.
Let's circle that and come back to that.
But he'll even concede that Carvana doesn't make much money on selling cars. It's all on service plans and financing and all that sort of stuff.
Yes.
So if you say, okay, let's plug in a 2% profit margin, a 4% profit margin, start playing with some numbers. All right. I'm talking about a net profit margin now. Okay. If you're only starting with an 8% gross margin, you got to deduct expenses. 4%. And by the way, I'll even give them all the cost cuts. I'll concede all that. You still can't get to numbers that make any sense. By the way, just let me digress on that for 1 second. If Opendoor, all things being equal, which they never are, were to get rid of the 1,200 people that's been talked about, that Keith has mentioned should go from 1,400 to 200, if with a magic wand those 1,200 disappear tomorrow, which they won't, okay?
I think we have hundreds about to disappear due to the in-office requirement.
Correct. Okay, but let's assume 1,200 disappear, okay? I've seen estimates, people say, well, that would be maybe $250 million in savings, okay? And when you think about that, all things being equal, first of all, It's fanciful to think they could do that. But let's assume they even did that, all right? $250 million on 750 million shares, which is round about the share count outstanding, which, by the way, sidebar, and preparing for this call, I noticed one thing. There's this issue of the convertible out there, which there's this formula for the convertible that was issued back in the spring. I think it was like around $1.50 a share, but it converts at like $2.50. You may see another 150 million shares come into market soon, which is going to give you even more dilution. So the share count is going to go from 740 million or whatever it is to 850 million, whatever. Anyway, let's get back on point. $250 million cost cutting on 750 million shares is only 33 cents a share pre-tax. Now, I know they have a tax loss carry forward, but theoretically speaking, put a tax on that, the whole deal. That's if they cut everybody. You're talking about 25 cents a share. So talk about a profit uplift on a stock which is at $8. That doesn't give you $82. Okay, so yes,
we moved 25 cents a share over lunch.
Exactly. Okay, so but in terms of earnings, okay, so that's kind of like a red herring. Okay, ignore in the overall scheme of things. Yeah, it's good they'll cut costs, and it's good it might put them into minor profitability, but it doesn't begin to get you to $8 a share. Forget about $82 a share. Okay, so let's come back to the earnings model. Let's assume they do $12 billion in revenues, and let's say they make a 2% profit margin, 3% profit margin, 4% profit margin. I'd be hard pressed to see anything higher than that.
Do you know Carvana's?
Oh, yes. Carvana makes about. I looked it up. Trailing 12 months.
Their gross margins are like 17, 18%.
Yeah, I was going to say even higher, 21%. But I was looking at trailing 12 months. But to answer your question, they made about $600 million net profit on $16 billion in revenues. This is trailing 12 months. So here's a company which he's using as the gold standard, which. In an industry where it's a bogus comparison, in my view, which has the benefit of huge profits from securitization and selling off the auto loans, okay? But they're only making a $600 million profit on $16 billion in revenues. So they're not. Which
is what, close to 3.5%?
Yeah, 600. Yeah, it's about 4%. 4%. Yeah. Okay. So just to contextualize the numbers I'm throwing out, okay, 2 or 3% is a very handsome objective. All right. So 2 or 3% on 12 billion, you're talking 240 million, $360 million, called 250, 350. Let's take 300 million as a single point to keep it simple. All right. On a company which has an enterprise value of $7.5 billion. Okay. So you're talking about 25 times that number 4 years out, 2029. Okay. You then okay. So you say to yourself, okay, they're going to make, if they make $300 million on 800 million shares, that's 40 cents a share 4 years from now. So let me get this straight. 40 cents a share, the stock's at 8. It's 20 times earnings 4 years from now. Well, to be consistent, you have to discount that back. 12%, 15%, whatever you want, okay?
Sure.
So you'd wind up with, like, I don't know, in a best case scenario, maybe the stock's 4. I don't know. So now we can play with those numbers. You may say, well, George, 12 billion is too low. It's going to be higher. I might say, well, we used Eric's number. I think it could be lower. You think it's going to be higher. That's fine.
Well, okay. So we've talked about the Eric Jackson approach a little bit. He's, of course, not using either gross profit or net profit to get to $82 a share. He's comparing enterprise value to revenue, right? It's an EV to revenue comparison, and saying, look at Carvana, right? EV to revenue of, I think, 5x, maybe 6x.
Yes.
Let's assume that Opendoor can get back to where it was over the next 2, 3, 4 years, which is 5x, right? And you compare enterprise value to revenue at 12 billion, and that's how you back into $82 a share,
okay.
At least according to Derek Jackson.
So
why is this EV to revenue metric dead wrong in your view?
No, we can use EV to revenue. We can use EV to gross profit. Let's just be consistent across companies. That's all. Okay. And what you just recited, Eric's methodology, is flagrant analytical malpractice. Valuations of companies tend to correlate to profitability and profit margins. Okay. There's a big difference between a company which has a 75% gross margin, say NVIDIA, and a commodity processing company, and say producer, processing company, which might have a 5% gross margin. You say, well, what's the point of that, George? I don't follow you. Sounds good. What's the point of that? Here's the point. If we have Jonathan Software, which has a 75% gross margin, for every incremental dollar of sales, the profits go up by 75 cents. If we have Jonathan low margin commodity company, say it's a copper processing company, it's making wire, and they have a 3 or 4% gross margin, I'm just making up numbers, okay? For every additional dollar of revenues, the profits only go up by 4 cents. So I want people to think about this, okay? If in Israel, I mean, it's a real life consequence here, okay? That's why, Palantir, say whatever you want about the stock valuation, it's not the point. You look at software companies overall, the reason they do so well, the operating leverage is explosive. Each incremental dollar, a large part of it flows through the bottom line. When you're stuck in a low margin business like Opendoor, it's only an 8% gross margin. It doesn't really move the needle very much. So when I say you can't get from here to there, all right, even when I give them the 12 billion in sales in 29, I give them the cost cutting. And you run that through a crude model, all right? The current stock price is wildly overvalued in my view. And what I find particularly noteworthy is, I've had a couple dust-ups with Eric, or I had one dust-up with Eric on a space. When you try to talk numbers, and I don't want to make this personal, but he resorts to ad hominem personal attacks, changing the subject, deflection. And then, you've had a couple terrific guests on so far, Jonathan, in your series. You had one fellow who I think worked at Opendoor, another guy who worked at Palantir, seemed like good guys, really knowledgeable. They've forgotten more about software than I'll ever know. But when you start to talk about numbers, it gets kind of squishy and they throw their hands up. So this is where the rubber meets the road. So again, I come back to
I want to double click real quickly though on revenue. Why is EV to revenue the incorrect metric?
No, okay.
For valuing Opendoor, and given that Carvana, I think, is a close comp in many ways, why do you see Carvana as the incorrect comparison company for Opendoor?
Okay, well, a couple things. There's a lot to unpack there. So one.
Yeah, let's start with revenue, and then we'll get to Carvana.
Okay.
Why is EV
so
to revenue?
let's say we had two real estate companies, okay? And I'm going to pick Compass as an example, and I'm going to comp it against Opendoor.
Very different model, though, from Opendoor Compass.
Yes,
right?
but I'm going to highlight, but when it comes to finances, you'll see what I'm getting at, all right?
Yes.
Let's say we had two ticket agencies. We have the George Ticket Agency and the Jonathan Ticket Agency, all right? And Jonathan sells $1 million worth of tickets. He's like a ticket master. It's like, he's just making a service fee. He's making 10%. So $1 million worth of tickets, he has $100,000 worth of revenue. Everybody gets that, okay? He never owned the tickets. That's the proper accounting treatment. But again, there's counting and there's economic reality. That's where people get tripped up. I don't want to get caught in semantics. Now you have the George Ticket Agency. George is not selling tickets on an agency basis. George is actually buying tickets from other season ticket holders and turning around and selling them.
Yeah.
So George sells $1 million worth of tickets, and it costs him $900,000 to buy those tickets from season ticket holders. So he makes $100,000 profit. So in economic terms, it's the same. Jonathan made $100,000 profit. George made $100,000 profit. But the accounting is very different. Jonathan shows revenues of $100,000. George is going to show revenues of $1 million, cost of $900,000, and profit of $100,000. So the accounting is very different. It's $100,000 versus $1 million. But the economic substance is the same. The reason it's different accounting treatment is because I bought and I actually took title. I own the tickets. You didn't, okay?
Yep.
So what's happening is when people say Carvana, Compass, and we'll get to Carvana in a minute, Compass is an improper comparison. Yeah, it is. You know why? Because it's much more profitable than Opendoor, but I digress. So if you want, so we can do this any way you want. Do a gross margin way, do a revenue way.
Well, I would just say let's not compare the revenues of Compass to the revenues of Opendoor. That seems off given what you just said.
No, not at all. To the contrary. And I actually have the figures here. I made sure I had them before I got on the call with you. Okay. So Compass, all right. Let's just so we're clear on this. Just so we're clear on this. Okay. Compass has 6.3 billion in revenues. They're only counting the commissions they're making. 6.3 billion. Okay.
Right. Imagine if they counted the homes. That's what I'm saying.
This is where I'm going with it. Okay.
Right.
Okay. So when I say Compass has 6.3 billion in commissions, hear this one. Okay. Opendoor, their analogous number is 400 million. Compass is 16 times greater. You want to talk revenues?
All I'm saying is Opendoor doesn't claim 400 million. Opendoor claims 5 billion. The 400 million.
We're saying the same thing, but hold on. Let's not get caught up in the semantics. Focus on the economic substance. Okay.
Just for the viewers, they're going to be confused when they hear you say Opendoor has 400 million in revenue because no one's saying that.
No, but Jonathan, let me finish the sentence. Okay.
Yes.
Okay. The meaning is being lost because I can't complete the whole thought. Okay. If you want to go with the 5.1 billion of revenues that Opendoor shows, okay. Yes. We can, in an analogous fashion, look at the total value of homes sold by Compass. It's not 6.3 billion. Wait for it. It's 263 billion. 263 billion. It's more than 50 times the size. So whether you want to do revenue, gross revenue to gross revenue, 263 against 5, or net revenue, 6.3 against 400, it doesn't matter. You get to the same place. And the funny thing is,
sounds like 100 bag.
Despite
sounds
Compass
like 100 bagger if you're using
despite Compass being 16 times greater in terms of gross profits and 52 times greater in terms of revenues, the companies have, it has a smaller market cap. Compass is at 4.4 billion. Opendoor is at 5.9 billion. Oh, and I'm not even going to get into the debt where Compass has very little debt and Opendoor not so much. So this is fanciful. And and part of the problem, this, Jonathan, you get in social, and this is why I'm really glad you're doing this interview for a lot of reasons. You're a smart guy. We can have a thoughtful discussion about this. People say, "Oh, George, where did you get 400 million from?" It's like, if you there's lies, damn lies, statistics. You actually think about the way the accounting is set up. Okay. This is the proper way to look at it. And let me give you another example. Uber. And by the way, I want to keep this appropriate, but I would like to point out that I was accused of being a liar by Eric Jackson. He said, "Oh, where did I ever make a comparison to Uber?" I think I shared the tweet with you, all right? When he was trying to put up comparables for Opendoor, he had Carvana, and we're going to get back to Carvana, and he had Uber. Uber, by the way, just so people can understand this, Uber has about a $200 billion market cap. They did about 162 billion in gross bookings. That'd be like the value of the houses sold. But Jonathan, when you go take a ride from Uber, the proper accounting for them is, because they didn't own the taxi, okay, they only show their cut, which is 43 billion out of 162 billion, okay? So Uber on EV to sales, okay, is 5x. On EV to gross bookings is 1.2x, all right? And I would just say, coming back to Opendoor, people say, well, Opendoor is iBuying and Compass isn't, and blah, blah, blah. But, over the long run, on average, the margins might be a bit higher in, given the benefit of that, might be a bit higher in house flipping than in commissions, but it's a very hard business. So far, it hasn't been the case. I've lost money every year. And the last point I'd like to make is, it's a tough business. It would be valued at a very low valuation in the market. I'd like to remind viewers that book value per share of Opendoor is only 86 cents per share. I think $1.50 for a stock price would be reasonable. You look at home builders, they're trading it. So they're trading maybe 1 or 2 times book. I mean, they even go below book when things are bad. So I think now let's get to Carvana. I think it's a very fallacious comparison.
Yeah, let's get to Carvana because Carvana has a similar model to Opendoor, right? Where they buy the cars, right?
Yes.
The cars are assets, and then
Yes.
they sell the cars.
Yes.
And if you look at Carvana's revenue, so
Yes.
top line revenue, they include the value of the car, right?
Correct.
But then if you look at gross profit, it is a little chunkier than Opendoor's. As we said, I think it's like 17%. You said 21%. It's like way higher than Opendoor's,
Yep.
right? But it's a similar model in that they're taking the cars onto their balance sheet and then selling the cars, and the entire value of that car is revenue. Oh, Carvana also, to my knowledge, has this like big services suite. And as you said, there's some securitization in there, and they make money in other ways that Opendoor does not. And that's really important. But Carvana really is like the Opendoor for cars, right? Or Opendoor really is the Carvana for homes. Is that wrong? Why is that wrong, George?
I didn't say it's wrong, but it's incomplete. The devil's in the details. Okay. So correct. The gross margin, you said 18, I said 22. Let's just call it 20 between friends.
I haven't looked at the numbers.
Doesn't matter. Okay. All right.
Yeah. It's
okay.
But it's priced. It's double Opendoor's.
More than double, because Opendoor's like an 8 versus 20. Okay, fine.
At least double, yeah.
Okay. And so to start off with, and by the way, when you were citing the price to sales or multiple that Opendoor achieved at the height of the SPAC mania a few years back, that's also very spurious. That's like, I mean, that's the bull market crazy stuff. Like anyone who'd use that as a reference point should have their head examined. All right.
I agree.
Okay, that's when the market lost its collective mind. Okay, so if I try to hustle you with an elevator pitch, Jonathan, and I'm saying, oh, it should go back to a stupid price. Like, come on, who says such stuff? Which, by the way, brings up another point, overarching point. When you hear, usually the way I try to market an idea, or if I try to convey an idea, I try to give facts and let the other party decide whether it's reasonable or unreasonable. I'm sure, Jonathan, you've been subjected to pitches where someone's really trying to give you a hard sell and they're exaggerating stuff and twisting stuff and taking stuff out of context. And it's like, ew. It's like, if it's that used car salesman type of hustle. Well, that's what's going on with Opendoor. And that's why I'm jumping out of order here, but people say, George, why are you so invested in this? Why are you so, old man, you have too much time on your hands, you're a boomer, all this kind of stuff, all right? It's because I can see this. I can see what's going on. It's embarrassing. It's unprofessional. It's factually incorrect. It's an exaggeration. Anybody working at a real financial firm would have their compliance department shut them down so fast it would make your head spin, all right? It's just wrong, okay? It may be legal, but that's because the laws aren't correct, or the laws aren't being enforced the way they should be, which, by the way, sidebar, Eric took issue with the fact that I did say I had reached out to the SEC simply because in one of his tweets, and again, Jonathan, this is great. I'm able to answer some questions because Eric kept interrupting me. I couldn't answer a single question, all right? Eric did say that they reached out to, I think, the entire Opendoor or employee base, and they're hoping to, I think, get 25% of the contact 25% of the employees of the company. I think it was for the purpose of purchasing stock. Okay, that could be an SEC violation. All right, but the SEC doesn't enforce anything in these. I don't really know. So, Eric, I'm sure you're watching this, Eric. If you want to know why I reported you to the SEC, that's why. And if you want to respond to any of the numbers that I'm reciting here, you're so welcome to do so. I will assault you with facts, not insults and ad hominem attacks and deflections and logical fallacies.
All right, let's get back to Carvana, because I want to hear why those models.
Okay, so
why the businesses themselves are. Why it's the wrong comp.
Okay, they're very different business. So a couple things. So the first point, in which I think you and I agree on, the vast majority of Carvana's profits come not from the sale of the car, comes from ancillary services, be it service plans, mortgages, etc. Okay, so that's one. Now you might say, well, couldn't Opendoor do that someday? Okay, well, Eric likes to talk about mortgage and title. Title's a commodity. You're lucky if you make $500 on that. It's a very competitive business. There are big players in there. That's not going to move the needle. That's ridiculous. Okay. So let's talk about mortgage financing. mortgage financing is a very competitive business. There's some big players in that business. Okay. It's a commodity, and I don't see what particular expertise that Opendoor brings to the table to be successful in that industry. I know there's been talk about assumable mortgages, which is another possibly bridge too far. It's a very tough area. So to represent that's going to be a big contributor, that's a bit of a stretch. I mean,
there would need to be a policy change,
correct,
as I understand it, for that to be material.
Correct. So, you might say in pitching the case, either bullish or bearish, these are things that could happen that make the story worse. These are things that could happen to make the story better. But to mention prominently assumable mortgage as one of the bullet points, to me, is ludicrous. All right.
What about fixing up the home after someone has bought it?
Again, a commodity business. And then so you're talking about. Sorry,
I don't know of anyone else selling homes that like includes fixer up as part of the package.
Well, there's a price for everything. Okay, just like there's a price for what Opendoor does. I mean, I know you're aware of this, Jonathan, but if you look at the old Opendoor, okay, whatever the new Opendoor is going to be like, we don't know, but the old Opendoor, okay, they are, and I'm going to get back to why it's a bad comparison to Carvana. They're really, you talk to anyone in real estate, and it's not because their agents should be anything. No. It is a horrible, horrible value proposition. I'm sure you've read the same things I have. On average, I think they're buying homes at 8% below market. Then on top of that, they're charging a 5% fee. Yada yada yada.
That will change. Both Keith and Kaz have said
I know that will change. Okay, but they talk about getting rid of the agents, so on and so forth. But the point of it is that there's a price for everything. All right, and the home, another really important point that I think needs to be made. It's not just the services, but also think about it, the price. A lot of times you go to sell a used car, $20,000, $30,000, $10,000, whatever it is. All right, it's like, you know what? I just want to get rid of it, trade in. I'll take $1,000 or $2,000 less, whatever. Okay, it's not. It's a tiny transaction compared to selling a home, which for most people is the biggest asset in terms of their net worth. So the idea of like, oh, I'll just sell the thing for 5-10% less because I want to get rid of it, doesn't work that way. I mean, people fight over 0.5% or percent. So the reason, like, okay, we all want lower transaction costs, but there are a lot of externalities in the buying and selling of homes. Homes are not commodities like cars. Okay, if you own an Audi S4 and I own an Audi S4, it's the same car. Yours has got more miles on it. Mine's got less. You drive like crazy. I don't. So we have a baseline and we can tweak up or down depending on the condition and the mileage. Okay, homes are not commodities. Each one's different. Okay, and there's an informational.
Is that really true? Like in the center of the barbell?
Well, okay. If you're going to be, say, in a big town,
I think my guess is that like 80% of homes are sufficiently similar that an AI could price it far better than a human. That is my assumption.
Okay, I would disagree with all of that because one, if you're in a development, say a big townhouse complex, yeah, they are all similar. Okay, yeah. But if you're not, no, they're very different. Okay, different locations, different configurations. Different ages, and I would argue, when I'm not defending agents, but I think the agents do what are you paying for when you hire an agent, among other things, pricing, and I think I don't think for a second AI does a better job than humans in pricing these homes.
Okay, I guess we'll see. I guess we just disagree there.
That's okay. That's not really the main. That's not really the main point here.
Well, I do think, Matt. I didn't mean to suggest the homes in the 80% middle of the barbell are similar. I meant to say that they are easily priceable by AI, and I think we'll find out why.
That may be the case, but I wouldn't go so far as to say that they're better or whatever. Okay, So, but you come
I do.
back to. Sorry,
Okay.
go ahead.
I do think they're better for Opendoor to sell because they're easier to price in an automated way.
Yeah, I mean, they can use AI, but fine. But that doesn't give you. Yeah, there'll be some cost savings. I would hope they would use AI because they want to get rid of 1,200 people. So I already given them credit for that by giving them $250 million in savings.
Right.
What did I
All
miss?
right. Yeah, let's move. Okay, so let's continue with the idea that Carvana is an incorrect comp to Opendoor.
It's complete speech. Again, John, let me come back on one point, okay? Again, let's make a third person. If I gave you two companies in two different industries,
Yeah.
one has a 25% gross margin, one has a 5% gross margin. One consistently makes, you'd be like, well, even if everything else was the same, you'd value the 25% gross margin company at a much higher level than the 5% gross margin company. And there's nothing I really see that's going to move the needle on gross margin. By the way, there's another point here, which is the asset heavy nature of their business. Okay, namely, since it's in the house flipping business, and typically it's taken them 3-4 months to sell the house. You look at how quickly the flywheel can turn. Right, it's very capital heavy. If you start getting into how much capital it would take to sell, they throw out these numbers. Oh, they're going to get 10% market share, just like Airbnb does, just like Amazon does, just like Tesla does. Oh, we'll snap our fingers like that, right? How's that going to happen? Where are you going to get the billions and billions of dollars necessary to do that, right? So it just makes no sense whatsoever. But anyway, the capital intense nature of this business is such that the flywheel can only turn so fast. Well, if you're a broker, you're not constrained by that at all. So major fail on capital intensity as well. And ditto, by the way, okay. And Carvana, by the way, keep in mind one thing. Yes, they do buy the cars. However, cars turn over much more rapidly than houses. And also, Carvana can and does sell the houses into the wholesale channel. So they can get out of these cars extremely quickly.
Yeah, that was a good and very important point that Sebastian made on episode 4, which is that this industry moves slowly.
Yep. Homes
sometimes take months to sell, and sometimes it takes years for you to observe changes in the housing market. Mm-hmm. So I do think that that's a good and important point. I'm happy you brought that up.
Great. So I guess Jonathan, so where I come out of this whole thing is like, I wish them luck, but and hopefully they'll come out. Rome's not built in a day. I expect in the coming weeks, and I think they're having quarterly earnings the first week of November, they'll come out with some more definitive plans. But I've yet to see anyone explain a credible path to making profit sufficient to justify the current share price. Forget about $82, okay? And I just don't see how you can get from here. I just don't see how you can get from here to there. It just doesn't make any sense. I'd like to point out that Eric Wu, who I think is coming back on the board, he was CEO of the company from inception until December of 2022. So his hands were firmly on the wheel of this company as it was losing money year after year after year. And Eric said, I saw something recently where he said something like, oh, well, the model is working fine until, the housing debacle. No, it wasn't. They lost money every year. So this thing has never worked. Maybe it will work, but it has never worked. And again, I go back to the way I was trained. One of the things Peter Lynch always says, look at a company's record. And a company like this, let's hope they turn around, but it's really a show me situation. So for people to go say, okay, we're just going to suspend disbelief, and it's going to go up 100-fold because it's cool, and this guy's standing out in front of Drake's house. This is not the way this business works.
So I want to talk a little bit about what sort of revenue multiple is reasonable, right? Given everything we've discussed. As you've said, 5 times revenue, enterprise EV to revenue, 5 times, like Carvana, or like the situation was in 21, 22, is unreasonable. I want to ask what's reasonable. Is it 1x? Is it 2x? And then, like, if we agree on, say, 2x, maybe you think that's fanciful as well. I'd like to hear. But if you think 1x or 2x is reasonable, what revenues would be necessary in 3 years, and 5 years to justify the current to justify the current price?
That's a fair question, but you can't look at EV to sales in a vacuum. It all relates to margins. If I were to show you, say, for a given industry,
and we've discussed the margins, which, as you said,
right,
gross,
but you can't.
8%, maybe those go up a little, and net margins of probably 2-3%.
But think about this, Eric. Think about this for a second, okay? If you have a company, let's think about this exercise. You have a company which is selling on 5 times revenues. So $100 in sales, $500 market value, and they have a 3% profit margin. So profits are 3, prices 500. That's 170 times earnings. 170 times earnings. So to just say, well, it's 5 times EV to sales doesn't sound like too bad. It's 170 times earnings. Now, if the company's making a 10% profit margin, $10 in profits, and it's selling at 500, it's 50 times earnings. So I think 5 times sales for
I'm not advocating for 5 times.
I'm not saying you are. I'm just trying to give you the framework to think about. Everyone at home should do their own numbers. They can go with their own assumptions. Okay.
Yes.
And when you do it that way, when you're a low margin business, okay, you don't get 5 times sales. I'm sorry. I go back to Compass again. Okay. Compass has a $4.4 billion market cap. Okay. Their commissions, forget about their gross sales. Okay. Are $6.3 billion. It's selling on 0.7 of sales. So, you want to tell me that, Carvana in 2029, Opendoor in 2029 does 12 billion. This is your number, 15 billion. 15 billion.
I think Opendoor will be targeting closer to 50 to 100 billion in the coming years.
So how do you think they're going to get there?
They're going to buy 10 times as many homes.
And where are they going to get the money for that?
They may have to raise some money to do that. We'll see. Or maybe they'll take an asset light approach. But they will need to scale revenues probably 5.
Well, if they're going to take an asset light approach, they can't do iBuying anymore. Now you're in the brokerage business. Now you're Compass.
I'm just talking about number of homes. Like the number of homes that need to go through the Opendoor some way, somehow, needs to scale probably 5 to 10x.
Yeah, it needs to. Doesn't mean will.
In order to justify the current value.
Well, yeah, and the number of homes has to go up big time just to justify the current stock price. Forget about 82. I mean, Eric, John, think about it for a second, okay? Let's go 20 billion. Give me any number you want. I don't care. Give me a number. What do you think? So we use Eric's number of 12 billion. It does not compute for the valuation, okay?
So I actually don't think EV to revenue is the right multiple. I think something like EV to contribution profit is probably
correct. And by the way, another footnote. Eric accused me of not looking at EV to revenues is important, which I did, not EV to profit. Which is why I go back to I tried to give you a way of building a profits-based model. Okay, so we go back again to if you said, well, they're going to do 20 billion in sales, okay? Or let's do 50 billion in sales. Let's go crazy, okay? Let's just do 20 billion in sales first, okay? 20 billion in sales. Give them a 3% profit margin. This is profits based. $600 million in profits for a company which today enterprise value is on $7.5 billion. So 12.5 times your number now, 20 billion. We're being very generous here with the assumptions, okay? Discount that back. You still can't justify the stock price. Let's do 50 billion. 50 billion. Do I hear 50 billion? So 5 billion to 50 billion. We're stress testing it. We're stress testing it so much, rubber band's breaking. 50 billion, 3% profit margin, which would be fabulous. It's $1.5 billion in profits. So 10x revenues in 4 years, $1.5 billion in profits. Put a multiple on that, discount it back. Maybe it's a $12 stock. I don't know. I mean, reasonable. You could say it's going to be 15. Well, hold on. You could say it's going to be 15. I could say if it's 5, it could be 9. Eric, Jonathan, it's not 82. It's nowhere in that area code.
Right. So I think I think there are some qualitative assumptions that somehow, some way need to enter the model as well.
Okay.
Which is that Opendoor has a different sort of mission than Compass or Anywhere Real Estate, any of the companies that you've used, which is to say the goal is to literally transform the industry.
No, the goal is to make profits.
I mean, if you talk to Kaz, like making profits is in service of the mission. Like you could disagree with that or say it's fanciful or what, or
whatever. That's not really the point. I mean, listen.
Like we've seen time and time again over the last 20, 30 years, companies with ambitious missions, companies really that are tech companies, valued in a different way because they're categorically different types of businesses than those that came before. And their relationship with the world and the world that is left in their wake is fundamentally different because of them. And they're valued differently.
Yes.
And what I would say that needs to enter the model somehow, or at least it needs to enter your mental model for how we explain the valuation.
So what number? I gave you my numbers. I mean, we did 12 billion, we did 20 billion, we can do 50 billion. Tell me what you want. Garbage in, garbage out. I mean,
again, I think many tens of billions of dollars
of what
is a reasonable expectation
for revenues.
Correct.
Right. And so, like I just said, if you want to put 50 billion in, and you said give them a 3% profit margin, and it's $1.5 billion, that's $1.5 billion, and then tell me what multiple of profits do you want to put on that 4 years from now? Give me a number.
I'm asking. So I honestly don't know. Like what multiple of profits are put on transformative tech companies that are growing at, I don't know, 2 to 3x year over year.
Okay.
They're extremely high. They're extremely high multiples.
Sure. And the thing is, for every company, everyone wants the next Amazon, the next.
We actually have one that's been compared to Amazon like for the last 10 years. An incorrect comparison, right? But one that has been made and will continue to be made. This is like the Amazon of homes, according to those in control of the company right now. That's what they want it to be.
Right. And Amazon, for a couple things. One, think about it. Amazon, first of all, on the retail side, all right, that's a commodity business and they've scaled. The model's totally changed. They went from you going to the store to you buying the stuff at home, and they explain to you unit economics and so on and so forth. It's a totally new model. Okay. So again, I'm willing to entertain a discussion of what a new model might look like. Okay. What I'm saying is I'm enough of a Luddite that I don't see it. Not only that, none of the proponents of the stock have been able to articulate what it is. They just say AI, and they throw their hands up and that's it. It's all fluff. So I get back to the unit economics. Show me the vision. Hey, listen, I'll be the first one to reconsider what I'm saying. But A, no one's been able to show me anything. And B, what people are losing sight of, the move in the stock from $2 to $8 or whatever, you already have a company with a $7 billion plus enterprise value, which is extremely generous. Does not reflect the current. Certainly, there's a lot already in the price for what's going to be. It does not reflect the fact that this company loses money and has an 86 cent book value.
So I want to get this out of you. What revenues will be necessary with the current model or something like it to justify $8 a share?
Well, we can go back to we were throwing some numbers around earlier. Okay. If we let's start with a $12 billion consensus number. All right. Yeah. I think a 3% net margin, which they've never been able to do. Never. Okay. It'll be $360 million in profits relative to the $7.5 billion enterprise value right now. Or if you want to look on a PE basis or whatever you want to choose. And then discounting that back by, say, 12 or 15% a year, okay, you'd be woefully short. All right. I think $12 billion. I mean, if they want.
Where wouldn't you be woefully short? At what level of revenues?
By the way, when I say short, I don't mean short the stock. It comes up short in the analysis. Okay.
Right.
Okay. So if they were to say 20 billion, I'm just going to make the talk. But again, it's like when you're in high school, show your work, not just what the answer is.
Sorry, 20 billion of profits or 20 billion
of transactions. Okay. Assuming, I just want to walk you through again. We can't be precision here is not the name of the game. Accuracy is. I'm trying to explain the thinking. All right. If you did 20 billion in housing sales and sold homes, and you had a 3% profit margin, which I've never been able to do before. Okay, that would be 600 million in profits. Put whatever type of valuation you want on that. Discount it back. Okay, that probably gets you to about where the stock price is now.
Got it. Okay.
I mean, it could be 15 billion, whatever, probably something like that. So,
So they only have to 4x their revenue to get to something that you think is reasonable. Is that right?
Wait, they only have to I want to make sure I heard this right. They only have to 4x to get to a level and get their margins up to levels they've never been to justify the current share price. Is that what you just said?
I think that's a base assumption that they'll
okay, fine. They're going to 4x. That's fine. That's fine.
It's hard to overstate how bad the former management team was, in my view, like as a shareholder for a long time.
But hold on. Both can be true. Both can be true. They can have bad management, and you can still be in a bad industry or have a bad business model.
Totally. Yeah.
Okay, so they both can be true.
Yeah.
So I just, look, at the end of the day, it doesn't matter what you think, what I think, what Eric thinks. The fundamentals will determine the outcome. And
I mean, George, I'm with you that like if we don't see 3 to 4x, an attempt to scale revenues by 3 to 4x, probably like if there are not tea leaves that is coming over the next 6 months, the stock price will retreat quickly. But I don't know. I think the expectations and what we're hearing out of Keith and Kaz indicate that something like that is coming.
Yeah, but I would say it's already in the price. That's why that's already in the price. Okay. In other words, you go back. Got to remember something.
That is in the price, but what's not in the price is a fundamental transformation of the model, right? Which I don't know
to what iBuying. I mean, they claim so far. Keith insists they want to stay with iBuying. So you know better than Keith. I know better than Keith. Eric knows better than Keith. I don't think so. What's the new model? Is it iBuying?
I think iBuying will be a part of it. What I'm assuming is that they will tack on all sorts of things that make this a very, very different sort of, much more compelling business than it's ever been in the past. Again, the moment that assumption, the moment that it becomes clear to me that assumption proves to be fanciful and like detached from reality, I think it will be time to sell. But I'm betting on Keith, Kaz, Eric Wu, and the world-class engineers that they're able to recruit over the coming months. But
right, and again, I have no position in the stock. I have no idea what the stock's going to do in the next few weeks or months.
Yeah.
I just think that on anything but a very short-term view, the stock's wildly overpriced. One last point I'd like to make on valuation, Jonathan. You could be right on the fundamental development, but markets have a way of discounting things pretty far ahead. And I could cite you chapter and verse. I'll give you one story, as many I could, but I'm reminded of there was a famous investor, Peter Vermillier, who passed away a few years ago. And I remember at the funeral, someone gave the eulogy, and this is Chuck Clow, who was formerly the chief investment strategist for Merrill Lynch, and he told back in the day he worked as an analyst for Peter Vermillier, and he told the story back in the days, like in the 60s or something like that. Chuck was the airline analyst, and airlines were a great growth industry. It was a go-go stocks, right? So he gave the whole pitch why you should be buying this airline stock, that airline stock. And Peter, this sort of tough New England Yankee type guy, in a very gruff voice after hearing the story, said, "Price." And Chuck's like, "What do you mean price?" "Price." He said 3 times. "What do you mean price?" And Peter explained, "It's already in the price. Stocks have gone up a lot already." Or you look at Walter Deemer's wonderful, and he's on X, anyone can access this, his wonderful example when he was at Putnam in the 70s, Putnam Investments. And McDonald's was a great growth stock in the 60s. And by the early 70s, may have the years off by a little bit, McDonald's had gone way up, and everyone loved it. And he put a sell on it. And for the next 10 years, it went nowhere. Why? Because McDonald's had already discounted the growth that was going to come for the next. The valuation was so insane at that point, it had taken on board already the growth that was going. The growth came. They were correct, but it was in the price. You made no money owning McDonald's stock. So it wasn't because McDonald's didn't deliver the earnings. It was because the price, the valuation already reflected the future prospects.
We may have that situation here. We'll see.
We'll see. Who knows?
The stock has 20x'd. If you're not at least a little bit cautious, you said you should have your head examined. That may be going too far, but you should be a little cautious. Even Greg, who wrote the initial due diligence post on Wall Street Bets, says that he's taken off. I think he said 80 or 90% off the table based on the 20x run that we've had. So I think that's reasonable. We'll see how much is in the price and not in the price.
And the last thing I'd like to say, this idea of 100 bagger, you can go look at the literature and you look at what percentage of stocks go up 100x. And when they do, it takes 10, 20, 30 years. So this idea of running around, it's going up 100-fold, it's going up 100-fold. I mean, that's like, come on. You think the average investor in Opendoor is well, A, what's the probability it's going to go up 100x, and has it only has a 1 millionth of a chance of going up 100x, and it's only going to happen over 30 years if it does. Okay, I rest my case.
Yeah, it's unlikely. I want to note, like, retail does an unbelievably good job of picking out some of these 100 bagger.
Mm-hmm.
And that's a phenomenon that I think professionals are going to begin to pay a little bit more attention to in the coming months and years. But final thing before we go, because I know we're way over. Jane Street disclosed a 6% stake. You were unimpressed. Why is that immaterial to you?
I just don't know. I mean, I want people to keep in mind here, Jane Street.
Eric Wu personally bought 450,000 shares.
Okay.
Why doesn't that move?
Means absolutely nothing, because Eric Wu sold, it was 100 million, 150 million bucks worth of Opendoor. I mean, some insane number when he was in the company before. So the fact that
so just optics then.
Yeah, it's that I discount completely.
Okay,
by the way, I'm glad you brought up ownership too. Another very misleading statement. It's again, the devil's in the detail. I was excoriated. I love when people try to put words in my mouth. Oh, so you think Kaz is an idiot? Why would he leave, Shopify? He must be a real idiot. There was stronger language than that used, I can assure you. Slight problem. And John, I think you and I discussed this. Kaz, I think, if you look at the stock awards, yes, it is true that the highest level of the tranche, I think, goes up to 33 or something like that. But the bottom tranche, he gets 40.9 over the next 5 years. If I read this correctly, and you read it as well, he gets 40.9 million shares if the stock is over $6.24. At today's prices, that's worth about $340 million. Not to mention the 30 million true up he got. It was 15 million cash and 15 million, I think, some RSUs. So the idea that Kaz is leaving a lot of money on the table, that is a lie. Not just I disagree with, it is a lie. And for those, I mean, here's a guy who's a skeptic, me, saying, "Oh, all the stock's got to do is stay over 624, and he's going to get $340 million." For those of you that think it's going to go to whatever, I mean, it's a slam dunk. So Kaz is not exactly. I'm sure he's a good guy, but let's just be very clear here. This is at a minimum highly misleading. So coming back to the Jane Street thing,
I want to say let's just get the situation on the table. He's making what, $1 a year in salary? Is that right?
Correct.
Okay. He's leaving a good situation in Shopify where I think he would make hundreds of millions in the coming years for a much, much, much better situation potentially where he stands to make many, many more hundreds of millions and potentially billions if the stock price is above 15, is above 20, is above 33, right? If stock price unbelievably gets to 40 or 50 or 82, he stands to make many, many, many billions of dollars, right? And so to your point, George, the idea that he's leaving money on the table, well, he did leave what he was promised at Shopify.
No, he's being given $30 million of consideration to true up, okay? I have no problem. If you said to me, hey, you know what? He's leaving, he's coming here, he's getting $1 a year. Unless the stock price goes to 15, 20, 30, he's going to get nothing, all right? I'm telling you, he's getting $340 million of stock over 5 years if it stays over 624. In other words, the stock price can go down 20%. He's still going to get his $340 million. That's a totally different kettle of fish.
I think it's been misrepresented. To say the least, it's been misrepresented by certain people on Twitter.
Like many things that the bulls cite, it's been misrepresented or omitted.
I've seen a lot of accounts talking about this, but I agree with you that not all of them are. And so I'm happy that it's come up.
Fair enough. What have we made, Eric? John, this has gone. I gotta keep calling you Eric. This has gone on for so long. We're having fun. You're still my friend. What else do we need to talk about here?
I guess final thing I was going to ask is, you're clearly bearish on Opendoor. Are you skeptical on the broader markets as well? Is this a mania? I keep hearing about the .com bubble. I was 7 years old around that time. Does this feel like that to you, or is this like 1996?
Well, listen, as Yogi Bear famously once said, predictions are difficult, especially about the future.
Sure. But you're in the business of making predictions about the future.
Oh, and business of being humble, too. I've made so many mistakes. So for all the haters are going to say, oh, it's this boomer guy. Look, I've had my wins, I've had my losses. If you're in this business and you haven't made mistakes, then you're a liar. Okay? It happens to all of us. All right? Yeah. I had an ETF that went badly a couple years ago. I've been very transparent and public about it. Okay? Trying to figure out whether this is March 2000 or it's 1998, I have no idea. What I will tell you is we've seen valuations on companies that we've never seen before. When you have Tesla, for instance, which is going to do, I think consensus estimates are for $97 billion in revenues this year and $5.5 billion in profits. And sales and profits are going down. And if I said to you, $97 billion in revenues, $5.5 billion in profits, what multiple would you put on that? I did this at a conference the other day. People said, $97 billion in revenues, $5.5 billion in profits. $150 billion, $100 billion, $200 billion. I said, how about $1.3 trillion? There was a noticeable gasp in the audience. Now, people will say it's all about the AI, it's the robotics, this, that, and everything else. We've been hearing this for years and years and years. It's still basically an auto company. So we've seen valuations we've never seen before. Valuation has been a handicap, actually, in looking at a lot of stocks. But at the end of the day, valuation does matter. Valuation is a horrible timing tool. But so I would say to folks, if you have your favorite expensive stock that you like, and you know what you own, okay. But there's three possibilities. You don't have to buy it. You don't have to be short it. Just like I don't have to own Opendoor. I don't have to short Opendoor. I could just say, this makes no sense to me. This is in the too hard pile, and I don't want to be involved. And, oh, by the way, I think ultimately this is going to end very badly, that this is AMC 2.0.
One of the reasons that this story is so compelling to me is that it's sort of the latest chapter in one of my favorite rivalries, which is like the finance bros versus the tech bros. And the tech bros, to your point, don't really think about valuation as precisely and as deeply, at least not in public, right, as the finance bros, who are sort of all consumed by valuation.
And to your earlier point, we got the retail bros. Okay, so
and I don't know what to make of them.
I know. But the thing about the and this is actually,
they're neither, to be honest.
I know.
But like all I want to say is that the reason I'm in Opendoor is that, like, I've looked at the public markets the last 10 years, the last 20 years, the last 30. I don't see a good reason to bet against world-class tech bros, people that are literally transforming industries, people that have built billion-dollar companies in the past. I think that tends to be a bad bet. And in this tech bro versus finance bro rivalry, I'm happy to bet on the tech bros really every time. I think that tends to be a very, 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 very good bet. To your point, the valuation raises a lot of questions here, and I think we'll learn more in the coming months. But
I think it's a very good point, Jonathan.
That's my perspective.
I guess I would say too that, look, we're all human, and I think one's perspective, your perspective, my perspective, everyone's perspective, the degree to which you believe that, sitting here in September of 2025, all things being equal, which they never are, probably in 2022 you wouldn't have said that. I can tell you
that was a bad time to bet on certain tech bros.
Correct. Okay.
It was a really good time actually to be investing in early stage AI companies. Like many of those companies
correct
are now 10 to 100
correct.
billion.
Correct.
Right?
Correct. But the point is, we're all human. We all are biased to some degree by the what is it called? The recency effect, recency bias. Okay. And right now that type of mentality is in the ascendancy. But sentiment has a way of following price. It's the way it always works. Price goes up, people get bullish. Price goes up, people get bearish. So it's the market. I mean, that's the way it works.
Yeah.
So
well said.
By the way, one last thing on Jane. I don't know if we didn't complete on it.
Oh yeah.
Yeah. But it occurred to me. The reason I don't put a lot of stock in the Jane Street things, keep in mind this, Jonathan. Jane Street's not just a traditional fundamental investor like Tiger would be or Soros would be. Right. Jane Street does a lot of stuff in options and market making. So I don't know. I don't know. I can't answer the question. Okay, but the people who are championing the Jane Street position are answering the question, fitting their own narrative. They're totally ignoring the possibility that, well, hey, wait a second, this may have nothing to do with, this may just be hedging, an options position or something. So
is there any, so I've heard this idea, and I don't know how to evaluate this. Is there any chance that they bought up all of those shares so that they can lend them out to shorts?
That's a possibility too, because when you're a market maker, what you could do, you could lend them out to shorts, and then you could buy, calls or puts or whatever to hedge yourself. So, Jonathan, I'm humble enough to say I don't know the answer, but my issue is not that I don't know the answer. It's that the people who are citing this explicitly are claiming they do know the answer. Okay, it's just the wrong info. I mean, if I walked into Peter Lynch's office or my boss said, "Well, how do you know it's not that?" I'd say, "Well, I don't know that." But the knuckleheads claiming that this is a sign of the imprimatur, it's a good housekeeping seal of approval, they don't know that either. But here's the problem. Here's the problem, Jonathan. This gets to a bigger point. They don't know what they don't know. Okay, they're not even aware that there could be other. I mean, one thing if they used to me, George, I've looked into this and I figured, no, Jane doesn't do this. Fine. But they don't even know what the question is. That's the problem. And by the way, that's also a bigger problem with what I would refer to as the democratization of finance. As you know, you've been in that long enough. There are a lot of inside baseball details you get into in certain situations where the sort of elevator pitch, 30,000 foot view, you totally miss critical information. And I would humbly submit for your consideration that as regards Jane Street, this is really a case in point. So I dismiss out of hand those who claim they know why Jane Street has bought this stake.
Great.
And by the way, you want to talk about ownership? So how much have you looked into, John? I haven't looked into that carefully. Have you looked at this convertible bond, which 2030 convert they just issued back in May. I think it was like 637 shares per bond. It's like at $1.50 or something like that. But it's got this thing in it where if it trades more than a certain percentage above the conversion price for, I think the conversion price was like 250. I can't remember the exact numbers. The point is, if the stock price trades above a certain level for a certain period of time, it can be converted. So whereas previously, you thought these bonds, when the stock was languishing, these bonds would be out there for 7% bonds would be out there until 2030. You should go back and look at the 8K.
This is what you were talking about earlier, right? Where all
Yeah.
of these bonds are going. Yeah.
Yeah. So I don't know this, and here's the thing too. I tried to call Opendoor Investor Relations. There's no one to call. You can send an email in. All right.
Well, George, this should be public stuff, right? Like we can just take a look at the bonds.
Jonathan, it is.
I have not. I confess. Okay. I know nothing about it.
Here's my point. It is public stuff. And just like the other day, you and I were talking about, we were on the phone, and I pointed out the cows thing to you. You're like, holy shit, right? Okay, the $66.
What did you say to me?
No.
The cows?
The CAS stuff. The
CAS.
Okay.
Yes.
And I pointed out to, hey, Jonathan, it's $6.24. He's money good on 41 million shares. You're like, oh, shit, right? Okay. You go back and look at the 8K. Like, I don't want to overstate my case, okay? But the way I read it, it's quite conceivable. There's like 120 million shares that's going to be hitting the market any day now because, not that the lockup expires, but because if the share price is above a certain threshold, I think it was 20 days, 30 days, you're allowed to sell. You can convert. Whereas otherwise, you have to wait till 2030 to convert. You might want to look into this. Again,
all right, we need to look into these bonds then.
Yeah. This is a clause which, you know what, Jonathan, I'm not.
I appreciate you bringing that to my attention.
Jonathan, I'm not too good with detail. I'm not too good with detail. And of course, Eric Jackson mentioned this in his elevator pitch. I just must not have been paying attention to it.
Well, on that note, George Noble, thank you for being a part of Open House. This has been fun.
Thanks so much. Always a pleasure, Jonathan.